This episode is brought to you in partnership with Forex.com, a leading provider of online trading services. Remember, trading Forex and CFDs carries risk and isn't suitable for everyone.
I became a little obsessed with these Chinese pump and dumps. Chinese companies would list on the US markets. You used to be through reverse takeovers. Now it's through IPOs. I found their websites. I joined 50 of the WhatsApp groups and I became good. At least I thought good.
I'm interested in how people are getting scammed time and time again, why people are falling for it. Is there potentially opportunities within this? Hello and welcome back to another episode of Two Blokes Trading. Today, I'm delighted to be joined by Edwin Dorsey, the founder of the Bear Cave, one of the most widely followed investigative research platforms in finance. Edwin has built a reputation for exposing corporate misconduct, digging through filings, FOIA requests, and executive shakeups to uncover red flags most investors miss. His work doesn't just inform traders, it moves markets and forces companies to face the truth.
These companies typically perform horribly, typically are having your share price manipulated, and historically have lied about their financials, although that's become less important. A lot of this manipulation occurs over WhatsApp. I even made a website, stopnasdaqchinafraud.com. If you're publishing information, the scammers like to punish those who publish on them. So if you criticize publicly, those will be the ones they just decide to manipulate even higher. It's really bizarre, and there's this kind of total underworld that is like targeting very unsophisticated investors, but it's huge, and it's like moving tens of billions of dollars a year to these US listed Chinese companies. But it's terrible.
In this episode, we're going to dive into Edwin's journey and the lessons every trader can take from his investigative approach. This is going to be a good one. Edwin, thanks for joining us today. It's a real pleasure to have you on our podcast. It's going to be a good one. I know it. I'm not a massive, short player in terms of the stocks, but certainly going to learn a lot from you today. So thanks for joining us today.
Jonathan, thanks for having me on Two Blokes Trading. I'm really excited to be here.
Yeah, look, I want to find out more about the Bear Cave, obviously, right? But before we jump into that, let me know a bit about your background. So I believe you wanted to get a job in trading. It never happened. I've done some research, but tell me about where it started.
So, Jonathan, I've been passionate about stocks from a really young age. Like second grade, I was all about the stock market and very obsessed with it. My transition to the short side happened the freshman year of college when, by coincidence, I got introduced to two of the big short sellers out there. One is named Mark Cajotes, and he's an independent short seller who used to run a big short-only fund. The other early mentor was Jim Carruthers, who ran $1 billion short-only fund called Sophos. I met him beginning of freshman year because he was reading an anonymous blog I was writing. And I started interning for his fund, and I interned for him on and off all 4 years of college. That kind of provided a baseline for me to get into this type of research. I also briefly interned in the SEC enforcement division. I started writing about companies a little bit on my own. Funny enough, one of your past guests, Gregory Zuckerman, played a big influence in my career because he wrote a story about safety issues at care.com, which was an angle I was exploring as a college student. And his story gave me a lot of credibility for highlighting these issues early on. Awesome. And ultimately, I decided to launch this newsletter my senior year of college, mainly as a way to get attention and get hired, because the fund I'd interned for, Sophos, was in the process of shutting down. So I started this newsletter February 2020, year as a way to show people I'm smart and hopefully have someone hire me. Yeah. But it quickly became big on its own, and now it's my full-time job writing this newsletter that's read by a lot of the short.
Awesome. So basically, you started the Bear Cave ultimately to kind of create a bit of a portfolio so you can kind of showcase. And then all of a sudden, it kind of scaled into really a huge publication now. I mean, I believe that happened somewhere around COVID. Is that right?
Yeah, so I started it senior year, February 2020. And I really lucked out on the timing because the best time ever to be writing an email newsletter in human history is right before the pandemic. People were online, people were bored, people were looking for stuff to read. They had so much time. People were on Twitter, which was my early way of getting people to check out the publication. People had extra money to spend on newsletters. So the best time ever to be launching an email newsletter was during the pandemic, and Substack had just started to take off. So I really kind of lucked out with the timing there. Originally, it was less me doing proprietary research and me just organizing and recapping that week's news, because there's a lot of activist short sellers and it's tough to track all of them. And there's a lot of like news on companies. So it started really as an amalgamation of the week's news and summarizing activist short reports. Because I just remembered when I was interning at hedge funds, it was tough to track all these. And that kind of just took off. And then that kind of became the free product. And I say, hey, if you like my recaps of the week's news, you might like my own independent research into public companies. And that's more the paid tier today.
So it's kind of evolved, right? But in terms of how it's evolved and how your systems have obviously evolved, I mean, clearly you're good at what you do because you've got a big following, right? I mean, how did it get to a point where you get to actually identify pump and dump schemes? And I also want to ask you, like, why is there so many companies from China coming on to the likes of the NASDAQ? How is this all happening? Again, I'm not a short seller in that case, so I'm kind of new and fresh to this myself. So I'm interested in how there's no regulations, how this is, how people are getting scammed time and time again, why people are falling for it. Is there potentially opportunities within this? Lots of questions around this.
Awesome. So that's a very broad question. There's a lot of angles to that question. So let me maybe say a few things. So it's not all pump and dumps that I write about. In fact, I would say the vast majority of what I write about is not pump and dumps. Typically, I like to stay above $1 billion market cap. My sweet spot, I like to say, is $1 to $10 billion public companies. Below $1 billion, there's a lot of great shorts and there's a lot of misconduct. It's just my readership and hedge funds tend not to care because there's not enough liquidity or there's not enough borrow. Above $10 billion, hedge funds love those, but typically those type of companies, if you've been around a long time, if you pass the $10 billion market cap threshold, I think your problems tend to be less egregious or might be in a division, but not applying to the whole company. So $1 to $10 billion is kind of my sweet spot to look at for companies because it's big enough that hedge funds will care, but small enough that there can be real issues and you still see like big share price movements and they can fall 80% if there's real issues. So that tends to be my sweet spot. And I say I tend to focus on three types of companies. Companies that are harming consumers. And typically what I'm doing there is I'm sending a lot of FOIA requests to state regulators to show how companies are harming consumers. Maybe it's overbilling, maybe it's making it tough to cancel. There's some issue that's relevant to the business. Companies that are misleading investors, and that can be a little bit like a pump and dump, or sometimes you just see these SPACs go public and the companies have no substance. It's just overly promotional. And then the third, which is a major focus for me now, is companies that are on the wrong end of disruption. During the Trump administration, these consumer protection issues are a little less relevant. So I'm really trying to think who's going to be hurt by disruption. So Signet might be hurt by lab-grown diamonds. Call centers are going to be hurt by the growth of AI. DraftKings might be hurt by the growth of prediction markets. Thinking like that and trying to be a little ahead of the curve. That's a big focus. Now, I have had a little bit of a detour in which I became a little obsessed with these Chinese pump and dumps. And basically for a long time, Chinese companies would list on the U.S. markets. You used to be through reverse takeovers. Now it's through IPOs. And these companies typically perform horribly, typically are having their share price manipulated, and historically have lied about their financials, although that's become less important. And a lot of this manipulation occurs over WhatsApp groups. And I kind of read a Wall Street Journal story about it and an Herb Greenberg story about it. And I said, let me figure this out and try to join all these WhatsApp groups. So I kind of figured out how the scammers operated. I found their websites. I joined 50 of the WhatsApp groups, and I became good, at least I thought good, at tracking these pump and dump schemes in which they tell people to buy legit stocks. Then they'd say, everybody buy this manipulated stock, and then it would collapse. I even made a website, stopnasdaqchinafraud.com, which is up today, which has 800 screenshots from these WhatsApp groups where anybody can upload screenshots so we can track what all the WhatsApp groups are promoting in close to real time. Now, unfortunately, I think these stocks are so manipulated that it can be even tough for me to accurately predict when these will collapse. So for the first three I wrote about, they collapsed 90% plus a week after I wrote about them. And then for one, I have a ton of egg on my face because I criticized it and it went up something like 10x 2 weeks after I wrote about it because they just continued to manipulate it. And seeing me get something so wrong that I think I had, timed correctly, it just made me feel very embarrassed and ashamed. So I'm kind of moving on from that, or saying, these things are just so dangerous. Maybe traders shouldn't be touching them, because even though they're going to collapse, it's just the timing is so difficult, even if you're in these WhatsApp groups, that I think at least publishing on them is not a smart idea.
Is that the allure though, right? That's the allure. It's the potential upside, right? It's the potential how much you can make from these kind of trades. And that's what keeps bringing new traders or inexperienced traders to the forefront of this, and that's why people keep getting scammed, right? I mean, it's Wolf of Wall Street all over. It's not going away. It's just incredible that people are still falling for these scams, and it's incredible that these Chinese companies, and it's not just Chinese companies, there's other companies, countries as well, coming in and doing this. But how there hasn't been a set of regulations in place to protect the consumer? There is in so many other areas of trading, but yet this side of trading just seems to be like a gray area that these guys are getting through the trap still. And how there hasn't been more oversight on this, to me, is just incredible.
So we're seeing with this Trump administration that they're actually really trying to focus on it. They announced a task force, which is like, who knows how effective that'll be, but they are prosecuting the executives of one of these pump dumps, OST. They are asking for more victims to come forward with information. I know they have started interviewing some victims who've also reached out to me. So it definitely seems like they're trying to care a little. I think partly because all the people sending these scam text messages are based in China or Cambodia. It's tough to track them, and the money goes overseas. So it's tough to like bring the enforcement there. But yeah, it's crazily egregious. And what I found is there's a lot of small ones in which are just manipulating, saying the share price is going to go up and down or whatever. But for the bigger ones, which tend to reach, let's say, 500 million to $1 billion market cap, these essentially non-substantive small businesses that list and then get promoted up in these WhatsApp groups, what the WhatsApp groups will do is they'll say, hey, buy this stock because we essentially have some inside info that a big US company is going to either invest or merge or acquire them. And what they'll do is they'll say the merger date, the acquisition date is going to happen on August 31st. And it's going to happen at $55 a share. So if you know that information, you kind of know how to trade it, because it's going to collapse before August 31st, and it's not going to hit $55 a share. And it might be at 10. So it's probably going to go to about 30, and it's probably going to collapse a week before the merger date or up to the day before the merger date. But after the fake merger date, they just lose all credibility and everybody would sell on their own. So it's going to collapse before then, and it's not going to hit the target price, because if it does, everybody will sell. So I think if you can get this information, it can be, possible to trade around it. It's just tough with the smaller ones. And I think if you're publishing information, the scammers like to punish those who publish on them. So if you criticize publicly, those will be the ones they just decide to manipulate even higher.
I mean, speculation is what drives price first and foremost. That's potentially where the upside is. But like you say, it's just how do you identify when it's going to collapse? This is where the trap comes, and this is why so many people lose, right? It's just like they're holding on for more gains. And the key is for these people to try and hold you into that position, right? Because they really control liquidity. They control the market essentially, right? If they're controlling, let's say 90% of it, they're controlling volatility. Once they dump that, it's gone. It's over, right? I mean, like that's.
You think that once they dump it, it's over. What often happens is you see it pumps and it dumps, and then 1 year later, they issue a ton of shares to themselves again at like 10 cents a share, and then they'll pump it and they'll dump it again. So sometimes they do it a third time, like just every year they're like reusing the same tickers, because their ability to pump and dump is only limited by the amount of tickers they kind of have under their control. And these are like huge operations. And the last thing I would say is it's really important for them to control the float. And once they start dumping it on people, like how do you control what they do with the stock? Typically, when you're in the WhatsApp groups, they'll only allow people to get in these operations if you've followed their trade picks in the past and done exactly what they said. And what they'll do is they'll make you send daily screenshots to confirm you still own the stock. And if you don't do that, you'll be kicked out of the group and not part of the scheme going forward. And if you don't do the screenshots, they'll threaten to report you to a regulator or say you're working with short sellers. It's really bizarre. And there's this kind of total underworld that is like targeting very unsophisticated investors, but it's huge. It operates through Facebook and Instagram ads, and it's like moving tens of billions of dollars a year through these US listed Chinese companies. So I'm optimistic it'll be shut down in the next year, or at least curtailed, but it's terrible.
It's similar to the meme coin type idea that's going on at the moment. It's pretty much the same thing, pretty much identical, but within a different marketplace, right? I mean, it's the exact same thing. It's groups, it's channels, it's WhatsApps, it's getting people to buy into meme coins that, 90%, like someone owns 90% of that, and they control the market. It's the exact same thing, right?
Yeah, I'm not too familiar with the meme coins. I'm more familiar with whatever meme stocks. I would argue that the level of sophistication here in the US listed Chinese companies is lower than perhaps basically anywhere else in terms of the investor base, because with meme coins, there might be a little bit of information asymmetry. With the US listed Chinese companies, you can look at the filings. There's a stock, Caprina Holdings, CUPR. I think it's dumped already. If you just look at the filings, it had a $200 million market cap. It does $50,000 in annual revenue. Most of these businesses are really small. They're like just small businesses based in Singapore or East Asia. And $50,000 a year, and I kid you not, they did maggot-based healthcare. The idea is that they'd sell you maggots you could introduce into wounds, and the maggots would eat up 30 bacteria. It's just crazy. All these are revenue declining, not profitable, few employees. And you can get those from the filing. But with the meme coins, there's probably there's not a clear SEC filing you can read, and some of them do work. I think just the level of sophistication in the US listed Chinese companies is so low, it's got to be worse than whatever's going on. With the meme stock, sometimes there is at least what seems like a reasonable case. GameStop did have a real turnaround aspect in part, and was probably underpriced at $3 a share. With these, it's just I read it and it's crazy. I literally have people who lost money buying one stock, and what these scammers do is they'll pump and dump one stock on you, okay, collapse 90% in a day, and then you'll lose all your money, and they'll say, we were attacked by short sellers. We got a second stock to make your money back. And then they'll recommend the second stock. And people will literally email me and say, is this stock a scam? And I'm like, I can't give you investment advice, but here's the 10K, 50,000 in revenue, 3 employees, never profitable, a $200 million market cap.
And tell me, do you use any AI to do any of your research at the moment? Are you utilizing AI for that at the moment? Is that helping you to identify this, or is it all kind of manual?
So Jonathan, I love that question, because I want to be as tech focused and future leading as possible in every part of my research process. Your past guest, Gregory Zuckerman, you asked him a similar question, and he said he uses AI a lot to help edit his writing. And that resonated with me, because I do the exact same thing. Before I publish any article now, I will upload the draft of my article to ChatGPT, and I'll say, please read through this and critique the 3 or 4 worst paragraphs and tell me why they're bad and how to improve them. So AI isn't writing it, but it will always zone in on 3 or 4 paragraphs where I'm clearly being too wordy, or, and help suggest edits. And I don't always agree, but sometimes it does find useful things. So that's kind of on the back end with the editing. And then in terms of research process, all the time. So one of my favorite things to do now is on a monthly basis, I'll go to ChatGPT. I pay $200 a month for the pro plan. I only use O3, and I try to use deep research as much as possible. And I'll say, please look through a list of all IPOs and SPAC mergers done in the last month or 2 months, and find ones for me that have high levels of consumer complaints or a pattern of consumer complaints. And maybe I'll tell it a few websites to look at, and look at Reddit or whatever. And we'll think for 20, 30 minutes and come back to me with a list of 10 companies that have high levels of consumer complaints. And a lot of the time, it's just not relevant. Yeah. Some companies just naturally have high levels of consumer complaints, or in industries with high level of consumer complaints. But usually 3 or 4 will stick out to me, and I'll do a little research, and 2 will really be interesting. And then I'll start filing FOIA requests on 2. It has led to me just like this early stage idea generation, finding companies I probably would have not followed. So now I can kind of get eyes on or do a little bit of research on basically all companies that are going public with high levels of consumer complaints. So I love that for AI. I just find myself asking it a ton of questions. So I use it a ton in the research process. I don't use it to write anything for me. And I'm typically not using it at the end stages, but just early stages, asking a lot of questions and trying to find companies that I might not have otherwise found. Very useful.
A big thanks to our sponsor, Forex.com, for supporting this show and keeping it free for all of you. One feature I think a lot of traders will love is that you can actually link your Forex.com account directly into TradingView. So instead of bouncing between platforms, you can analyze a chart, spot the setup, and place the trade right there. Another tool I really rate is their performance analytics. It doesn't just tell you your wins and your losses. It shows you patterns, like what time of day you tend to trade best, or which strategies are really working for you. That kind of feedback can make a huge difference over the long run. We're able to keep putting on these episodes every week thanks to partners like Forex.com. And if you're looking for a broker with strong tools and integrations, they're definitely worth a look. Just a reminder, trading Forex and CFDs carries a risk and is not suitable for everyone, so always trade responsibly. If you want to check them out, there's a link in the description.
Absolutely. It's incredible what you can do with them. I mean, we've been, me personally, like really pushing towards AI over the last 12 months with our software developers and so on. And we're really pushing it out towards our app, Travesto. Now, basically, even like you're saying, it helps you in that early stages, but you can even identify, like, do bottom to top, top to bottom company profiles and actually get that information like so quickly. I mean, we're pulling data from everywhere, whether it's like top news outlets, it's coming from top voices on Twitter, for instance. And also we're going to the charts as well and actually identifying like what's happening in the charts, collating that information and, creating that summary. Now, we're not saying that this is like this is just purely identifying. It's purely helping people not spend hours and hours trying to do their own research, but it's more just kind of like, okay, justification. Okay, yeah, this also, I agree with that. My bias is this. This also suits that same bias. That's strong, and it's just an additional help for traders and investors. And I think that's key, especially because people are becoming more time poor all the time, right? Everybody kind of wants answers and things happening right now. And I think you have to stay ahead with AI, otherwise we're all going to get left behind.
I totally agree, Jonathan. So I talked about using it for editing. I talked about using it for idea generation. You're talking about using it more in like research process and evaluating information. I think maybe the last subset where I see AI being really useful is helping build out like a suite of tools that can help people do investment research. So I'm more known for the newsletter now, but I hope to use the money I'm earning with the newsletter to build a bunch of software products to help people do research better. One of which I'm working on is called stockpromotiontracker.com, which essentially tracks all the paid stock promotions going on in the US and makes it into a database so people can see what's being promoted, what's moving on promotions. And the way that works in part is I hook it up to an email inbox. I sign up for all the stock promotion newsletters. And then I have a web developer I'm working with that has an AI agent scan every email in my dummy email inbox for stock promotions. And it's scanning to see, which stocks are being promoted. It's reading the entire email. It's reading the disclosures in the email and taking out the context that's relevant to, summarize. And it's, it seems like AI is like the very important step here where it'd be tough to do with web scraping alone. And it's a lot easier to have an AI agent tracking all the stock promotions. So I'm extremely bullish on the way that it can just unlock information. I think AI is huge.
It is. And I think the key is not just to feed it into one, have it feeding it into two or three, and then it working it out with the other agents, and then getting the real data. And little things like that will make huge improvements in your process, because sometimes you just find AI going off on its own tangent and hallucinating and coming back with some strange answers. And that's why the key is just to like keep refining. That's the key behind it.
I've also found it's weirdly bad at certain things. So I read tons of Glassdoor reviews, and I think there's a good way to do it and a bad way to do it. But I read so many, and I would have ChatGPT just, hey, can you look through every company in the Russell 2000 and find the 50 for me with the lowest Glassdoor reviews? Simple task, right? Unable to do it, lies about everything. And I think it's partly because the information's paywalled or there's anti-web scraping stuff. So when there's like difficulty getting like scraping information from these sites or visiting a lot, ChatGPT can't do it. And then it'll just start lying. So I found it really smart at some things and just absolutely atrocious at others.
Yeah, I agree. And I'll tell you, I'm actually really interested, right? Because you obviously focus on exposing, right? But you've never really gone into the trading side of things. And tell me why, first of all, that you've never gone into that side, because surely there must be temptation.
So I don't bet against the companies I write about in the Bear Cave newsletter. I only make money from reader subscriptions. Now, I do trade my money a little bit like in microcap stocks, and I have shorted some really like sub $100 million microcap companies just to get a little bit of experience doing it. But I'm not writing about it. So there's a kind of bright line. I don't short the companies I write about in the Bear Cave. There's a few reasons for it. One, I think there's a lack of regulatory clarity around the rules of trading around, short reports or, even just research you're publishing on companies or journalistic articles you're publishing on companies. And that's kind of how I felt 4 or 5 years ago. And it's kind of been proven true today, where you have the SEC and DOJ criminally charging Andrew Leff, one of the big activist short traders, for really his trading around short reports and, in theory, incomplete disclosures around doing it. So I think it's, from a legal perspective, it's a lot easier just to say, like, hey, I'm a guy with a blog, this is my journalism or attempts to understand the world, and people pay for it. That's very defendable from a legal and regulatory perspective. I think it makes you less likely to get sued, and it's a good defense if you do get sued. A lot of activist short sellers try to say, oh, we're journalists, and I don't think that's held up in court so well, partly because they don't have a consistent publishing schedule, partly because they're taking positions. And to be fair, if you're like taking huge intraday trades or short-term trades around a report, I don't know if that counts as journalism. But if you're not, and it really is journalism, and you just have reader subscriptions, then I think it bolsters the defense from a legal and regulatory perspective. I also think there's the incentive, as soon as you start taking positions, is to create stock price movements. And that's like a very slippery slope, because if you're going to take a position, then, why not also take a short-term options position? Why not work with a balance sheet partner? And then it all becomes like, what is the biggest single day stock move you can create? Because that's what drives the profits for a lot of activist short sellers. And then you're encouraged to exaggerate or use big red letters or, and I really try to do the opposite, which is I hope to gain a lot of reader trust over time. I really hope I can be kind of understated in a source of credibility. The final thing I'd say is I'm very documents based. I read SEC filings, I read lawsuits. I'm really good with FOIA. I'm less investigative, talking to sources and former employees and hiring a PI and that kind of lends itself to really like trying to create stock movements. Well, mine is really the kind of early stage research. So I don't think like you can, I think you do well. I think I do well running a short fund that held positions for a year, but it's tough to short. It's a lot easier to make money on the long side. And I think just the model I have is easier from a legal and regulatory perspective. It works for me. It builds trust with readers. I'm not saying I'll never maybe pivot to activist short selling in the future, but I like my model a lot now. And it suits the type of more early stage idea generation type research I do, rather than this extremely deep source-based research activist short sellers tend to do.
Sure. I mean, we had one on the podcast before. They traveled to Colombia, rented a car or motorbike, went up the hills, and was met by like guys with armed guns, and they were like, okay, turn around and back. It's I mean, there's some crazy stuff going on, but it's how deep can you go? And that kind of pushes me towards the challenges that you face, even writing about it. You might not be like activist in that way, but you must get pushback from companies, right? When you're writing about them.
I've done this about 100 times now, criticized around 100 companies in the Bear Cave newsletter over the last 5 years. I've never been sued. I have gotten cease and desist, but honestly, the only really like tough one was the first time. And maybe I can go back and tell that story if that's okay, Jonathan.
Absolutely.
Which was in college. My friends knew I was really into stocks, and a friend of mine said, you should look into care.com, which is a babysitting platform. where babysitters advertise their services to parents and parents can find babysitters. And it was at the time $1 billion public company. And my friend said, like, they claim to be running background checks, but it doesn't seem like they're doing it. So I decided to test out the process myself by applying on care.com to become a babysitter as Harvey Weinstein. I used a photo of Harvey Weinstein. I made up all the info. And at the end, I consented to their background check. And they're like, we'll get back to you in 48 hours. And 48 hours later, hello, Harvey, you've been approved. They said I was CPR certified. I'm applying to all these babysitting jobs as Harvey Weinstein. I made a different account as like Donald Trump or something. And I like really proved that they weren't running the background checks they claimed to be doing. And I wrote a little report. It went kind of viral. And the company got really upset. And the co-founder called Stanford to try to get me in trouble. I think there were some donors like pressuring the university. And the dean of students met with me. The chief technology officer met with me. They said, you need to take it down. They said, you should email the general counsel and all this. And it's really intimidating because I was 19. I had no idea what I was doing. And my parents were livid. And I was getting in trouble. And so, but I decided not to take it down and keep working. And I think that the company sent a private investigator to my parents' house because my dad's like, somebody with a body cam just showed up at our house and was asking questions about you. And it was extremely wacky. And long story short, I cold emailed 100 journalists about this company and the safety issues. And the only one to get back to me initially was Gregory Zuckerman. Right. And then he spent a year working on it. And he had a huge front page story with, I think, 2 other co-authors, but he was the lead author about care.com safety issues. And I got a small mention in it, but it really like boosted my credibility. Mm-hmm. So that one was the scariest, kind of because I didn't know what I was doing. It was the transformative one, and it really led to the bear cave. After that, though, I think I have a really good sense of, if the people most likely to sue you or apply pressure are the ones who have sued others in the past, and I just tend to avoid them. Typically, smaller companies are more litigious than larger companies, and that's counterintuitive to most people, but also makes sense when you think about it because large companies can just avoid you. Like if you're legit or semi-legit, you're just going to kind of like avoid the criticism. While the small, truly bad actors, the $100 million microcap guy who's a complete like fraud and in the wrong circles, he's the one who's going to really target you. And like the penny stock pump and dump guys, they love to sue. And then finally, foreign companies are a lot more litigious than domestic companies. The one cease and desist I got was from a non-US listed company because I think just culturally, it's not as accepted to criticize those in power. It's just seen as ridiculous when you're doing it outside the US. On the US, it's broadly accepted that you can do reasonable evidence-based criticism of large public companies. And as long as you tend to be understated, which I do, and I really focus on being understated and not exaggerating, as long as you just kind of lay out the evidence, try to have a neutral tone of voice, you're not trading it. I think all of those like lead to my favor of being able to do this on a sustainable basis without being sued and, killed or something. And I would say finally, another thing that helps is I tend to write these articles and I might revisit it once in the future, but I largely move on. I think, where the biggest risk comes from a legal perspective and from a safety perspective is if you say, I know you're a fraud and I'm going to spend the next 5 years of my life making sure you go to jail and exposing you out. Like Mark Cahodes does do that and he does get a ton of pushback and he seems to love it. It's not my approach. So that's if you're respectful, you're reasonable, you're understated, you're laying out evidence, you're focusing on larger US companies, you can do this in a sustainable way. And I think it can work over the long run.
Sure, absolutely. Fair play. Without people like yourself out there doing this, I mean, like, to me, that's incredible. I mean, first of all, like the risks and dangers, putting somebody that's going to mind your child, number one, and for it to be, that's just, for me, that's crazy. I mean, there's this, I really hope whatever happened to that story that they got it right now, because that's really like safety. I mean, your kids' safety are at risk here. I mean, as funny as the story is you told, it's incredibly dangerous for this kind of behavior to go on, and how that's not regulated is crazy.
Gregory Zuckerman's Wall Street Journal article, everybody should go check it out and read it. Maybe you can link to it in the notes, but it
I
led to
will,
a
yeah.
lot of follow-on effects. Like the CEO, CFO, and general counsel of Care.com all resigned. The company fell, I think, roughly 50%. And then it was acquired by IAC. And then IAC, in theory, has fixed a lot of the safety issues and put in more professional processes into place. So and that was really exciting, not just from a stock perspective, but from a societal perspective where, the Wall Street Journal had a huge positive effect on society. And I like to say, the way I can have an effect is if I highlight issues, and I know a lot of journalists read the Bear Cave and I talk to a lot of them. So if I can highlight issues and then get a mainstream media person to write about the issues, and then it has a big societal effect, it's not just moving stocks, it's actually, in a small way, changing society for the better when done right.
For sure. And that's why you'll continue to grow and have huge success, I'm sure, into your future. But just going back to kind of your checklist, obviously you have that checklist, right? But there's a big balancing act between, okay, I've got this information now, but then to actually releasing that information, because there's time between finding that information out, verifying that information, and getting it out before the move happens, right? So tell me how that kind of plays out.
Typically, I'm looking at a lot of different companies at any point in time. There's so many times I start looking into a company, and I'm not saying there's no problems. It's just not egregious as I think. So it's a lot of times it's it plays out by not going anywhere, or I just have this folder and like all these notes on a company and then decide not to do it and revisit a year later and still decide it's not egregious. There's one company I've been broadly tracking for 5 years, and I just keep coming to the thing that it's not the time now, but I hope it's the time in the future. What Mirka Hodes says is that with short selling is, you want to wait till the Jaguar's out of the tree. So if you see a stock going up like this, you wait after the first break, and then it's the time to attack. I don't necessarily always follow that philosophy. Like I've published a few times on companies that were trading at all-time highs, like The Joint, which is a chiropractic clinic. Typically for me, the thing that will move me in a direction of deciding to write on a company or deciding not to write on a company is, if it's more of a consumer protection thing, is the results I get from FOIA requests. So the thing that I think I'm uniquely good at, maybe world-class at, is going to state regulators and filing FOIA requests, the Freedom of Information Act, to get consumer complaints people are filing against companies. Because anybody can write a complaint online. I think once you put it in writing and send it to a state regulator and the company has an opportunity to respond, it becomes a lot more real and you get a much better sense of how egregious the issues are. So the biggest thing in moving me from researching something to actually deciding to publish is the results I get from FOIA requests. Now, if it seems like the issues are really egregious, I want to kind of publish as soon as possible. I sometimes will look to see when a company's next earnings report is and decide I typically want to publish before then, because I don't want the earnings to come out and then to tank and then to come out after it. So I look at all these issues. But typically, though, the issues that I'm writing about, it's not, oh, they're going to miss earnings or overvalued by 20%. It's like, I expect them to underperform over the next 5 years. These are long-term relevant issues. The relationships you have with your customers and the integrity of your business will affect you for a long period of time, not a short period of time. So these aren't short-term trades. They aren't as time sensitive as you might think. A lot of it is trying to figure out, like, is this actually one of the most egregious situations in the market? Am I cherry picking issues? And I think that can be honestly like a weak spot for me, where, I might just see a lot of issues, but it's not relevant, or there's a different part of the business that's growing.
But that's your credibility at stake, right? Every time that you're going to publish something, you're ultimately in the back of your head thinking, well, this has to stack up, because if it doesn't, that's going to hurt, that kind of way. And look, it doesn't matter. All journalists are going to get things wrong, and it's just a part of the process. But it's like, you've just got to minimize them wrongs as much as possible, right?
Yeah. And I mean, it really haunts me. The worst article I did was problems at Palantir. And I said that when it's probably up 5x or something since then. It's like, it really hurts me. It's like, I clearly was a little bit ignorant. Even though I talked to a lot of people, I talked to customers, I thought I had, and it's like, darn, I think maybe that was a little more out of my wheelhouse, and it didn't involve FOIA, which is a real strength of mine. And it's just, it really haunts me to get this stuff, a little wrong. I've also found, though, is anytime you're publishing and have an audience, there's a lot of people who want to give you ideas, right? And I think it's especially true for activist short sellers, less true for me, but still to a certain extent, people are like, check out this, check out that. And I've really found that my best work is always stuff I do independently or with the aid slightly of ChatGPT. And the ones where I get it wrong a little can be if somebody gives me the initial, genesis of the idea and it kind of like clouds my thinking or makes me think in too narrow of a way. So I've really tried to, in order to not get stuff wrong, I think it's good to be as independent as humanly possible in just the entire funnel of the research process. I would say also I've really tried to focus on disruption as the angle, because we've seen so many of these. Like, I think a big problem with all the short sellers today is this is the golden age of stock promotion. You got tons of retail. You have all these stocks going up and to the right on no revenue and profits and nonsense. I'm really, really, really trying to think just disruption are always the best shorts, because if a business model is being disrupted, the downside is going to be huge. It's like a factor that is within your analysis and kind of control, for lack of a better word. And if you're right about the disruption, you're going to be right about the stock, and it's going to like impact the stock if there's a real business that's being disrupted. So I would say like my publication has evolved to the point that I'm now just constantly thinking about which companies are going to be disrupted from AI or, other, changes in technology.
I suppose before we do start wrapping things up, I just want to know as well, like the current market climate, right? We kind of have to touch upon it. Like, we're seeing all-time highs being hit. I mean, but on the same vein, we know that debt just continues to grow. We're seeing some big voices come out and say, look, I'm getting out. Some big hedge funds are saying, look, I'm just getting out. I think 3 years' time, we're at a breaking point. But yet we're still seeing stocks climb. I mean, like, what's your take on that?
I tend to not be a macro guy. I really want to tune out all the noise, avoid the stocks that everybody is talking about, and let me go to the basics. And I think sometimes when everything's hitting all-time highs and it's crazy promotional environment, it's like maybe avoid there's all these quantum stocks that my layman's view is are probably way overvalued and promotional, but I'm not going to even spend time doing that, because a stock that's overvalued can become 10 times overvalued. I think that's the Einhorn quote. Instead, one company I wrote about that I'm proud about is Acco Brands. And they make a bunch, and the ticker is ACCO. And they make a bunch of just really simple paper-based products like notebooks and calendars, physical calendars, and all these things that are just secular decliners, right? And I just know that business is going to be a little smaller a year from now than it is now, and 2 years out. And if I can find little things like that nobody's talking about, that are clearly trouble, that are clearly against the secular headwind, and just try to keep my wits about me and try to focus on companies that are just have fundamental issues, I think that'll do well over the long run. So I try not to proselytize too much or say markets are at all-time highs are going to go. That's just not who I am. I'm very, very company specific. I want to do company specific diligence. I want to focus on businesses where it's just being harmed by this disruption factor that's going to get worse. I just really want to just kind of stay sane and not talk about the Teslas of the world, not talk about the Carvanas, not complain about the market environment or say things are broken. I think I need to avoid companies with, tightly controlled floats like the China ones, because I thought I could be great at predicting them, but then it turned out to be a little harder than I thought. But focus on, companies that are liquid, above $1 billion market cap, have some structural issue, are being ignored by the rest of the market. And I think if I can do that and try to keep my wits about me, it'll be good for readers.
I love that. I mean, like, for traders, investors, it's all about finding your niche, and that's a great niche. It's about finding the disruptors, or it's finding the distribution line, or finding, these things are just key to getting your niche in trading and just having a slight edge over the markets. And it's awesome to kind of get your take on that and see how you slightly have a different perspective than mainstream. And that's very cool. But I suppose lastly, what is the future of Bear Cave? What's next for yourself?
So I've loved writing the newsletter. I'm grateful for every free or paid reader of the publication. It really means a ton to me, and I care so much about the publication. I want to do it for the rest of my life. So I think I want the Bear Cave to continue to be the dominant source of news for people following the short world. I want anybody who's, doing type of critical research on stocks to be a paid subscriber to the Bear Cave and just continue to grow it. I want to build up a great track record. And I think I had a great track record when I started. I had a few, slight screw ups later, but still an overall very good track record compared to the market. I want to have an amazing track record of identifying companies that underperform. And I think the second act here is continue to do the Bear Cave, do a great job with it, but take the money I make from Bear Cave to invest in software tools and basic research tools to help everyone do research better. I have one website, FOIAsearch.com, which lets anybody search the SEC's FOIA logs, which can help you detect undisclosed SEC investigations early. I mentioned earlier stockpromotiontracker.com, which I'm building out right now, which is becoming the biggest database tracking paid stock promotions in public companies. StopNASDAQChinaFraud.com, an open source database of these WhatsApp groups promoting stocks. I really want to take the money from Bear Cave and my knowledge from writing Bear Cave to invest in technology and technology tools to help everybody do research better. So the long run ambition is let me build out a suite of tools to help everyone do research better. Currently all free. In the future, there's going to be some monetization somehow. But that's the long-term vision.
I love that. That's awesome, and we should certainly connect on that in the future. But that's it's been so good to have you on, Edwin. It's been a slightly different conversation we have most of the time, but it's been a real pleasure, and hopefully our listeners would have enjoyed that and took some snippets of information and some golden nuggets, as they say, just to maybe help their own edge in the markets. But it's been a real pleasure, Edwin. Make sure, guys, to check out the links in the bios, and you'll see all of Edwin's links there as well. Thank you so much for coming on.
Thank you, Jonathan, and thank you for your thoughtful questions.
Not at all. It's a pleasure.
This episode is brought to you in partnership with Forex.com, a leading provider of online trading services. Remember, trading Forex and CFDs carries risk and isn't suitable for everyone.